Welcome back to the Deep Dive. Today, we're really tearing into the financial transformation of 3BBIF, that's the Broadband Internet Infrastructure Fund. We know this fund carries, well, pretty substantial debt. And for you, our listener, the key question seems twofold. First, has the fund actually managed to clean up its, let's say, complicated financials?
Right.
And second, if interest rates globally are heading down, how much does that really boost the dividend prospects for an asset like this, which is, highly leveraged?
Yeah, it's a perfect setup for a deep dive, actually, because Q2 2025 wasn't just like a good quarter. It was a real strategic pivot.
Okay.
We're looking at the numbers straight from their Q2 2025 reports, and they show this dramatic swing back to profit. It's driven by, well, both big accounting moves and some real hard cost reductions.
So we need to separate those out.
Exactly. We need to figure out what's temporary, the accounting flash, and what actually promises those sustainable recurring dividends investors are looking for.
Right. So our mission today is really to filter out the noise. We're sifting through these asset revaluations, the debt refinancing fees, all that stuff, to see if 3BBIF has genuinely established a reliable path for long-term income investors. Sound about right?
Sounds perfect. Let's do it.
Okay, let's kick off with the headline numbers then, because honestly, they are pretty jaw-dropping. The fund reported a net profit for Q2 2025, that's Q2 2568 in Thai calendar of 2,907.28 million Thai baht. Let's call it BPT.
Yeah, nearly 3 billion.
Exactly.
Right.
And to get some perspective, last year, same period, they posted a net loss of about BD 305 million.
Right. A loss.
So that's like, what, 1,000% plus turnaround in net assets from operations year over year? What on earth caused such a monumental shift?
Okay, so this is where we absolutely have to separate things into, let's say, two buckets. The accounting side and the operational substance.
Got it.
Now, total income from rentals, the core business, that stayed pretty stable, around BT 1,880.5 million. So the operational engine is steady.
Okay, steady income.
But that massive net profit jump, that BT 2.9 billion figure, it was significantly inflated by recognizing a specific non-cash profit, about BT 3,300.1 million of it.
Whoa, hang on. A non-cash profit of BT 1.3 billion. When I see a profit number jump that much, I immediately think, okay, how much is real recurring cash flow? And how sustainable is that kind of accounting maneuver? Where did that BT 1.3 billion actually come from?
Yeah, fair question. That specific gain is purely from asset revaluation, and this context is crucial. The fund hired an independent appraiser back in June 2025.
Okay.
Their job was to reassess the fair value of the fund's fiber optic assets, and they marked the value up significantly to a new total of BT 76,200.0 million.
So it's a paper gain, essentially.
It's an instant non-cash balance sheet booster. That's exactly what it is, and it's what allowed them almost overnight to wipe out that massive accumulated deficit they've been carrying.
Okay, so that BT 1.3 billion revaluation, it's like the essential cleanup crew then. It fixed the balance sheet, cleared the path for dividends.
Oh,
But it's a one-time event.
correct. A one-off.
So the sustainable story, the recurring improvement, that must lie more on the operational cost side. Let's talk about the debt costs.
Exactly right. The real ongoing structural improvement is definitely in the debt management. Remember, the fund did that major debt restructuring back in Q1 2025.
Yeah.
Well, we're seeing the full positive effect of that hit in Q2. Financial costs just plummeted, down to only BT 92.4 million for the quarter.
Just 92 million. Compared to what?
Well, compared to last year, that's a 56.68% decrease year over year. And even compared to the previous quarter, Q1, it's down nearly 70%.
Wow.
That massive cost cut, that flows straight through. That's pure sustainable improvement to the bottom line.
A 56% reduction year over year in borrowing costs?
Yeah.
That's incredible. The why behind that must be the refinancing they did, right? Taking out half their debt with a new lender.
It is. That's the core move.
Yeah.
They refinanced BT 5.5 billion of their more expensive debt, moving it over to SMBC.
And the rate difference was?
Huge. The cost of those funds dropped from a pretty punishing 6.9% per annum. Yeah. Down to a much more favorable 3.5% per annum.
Okay, 3.5%.
Just think about the impact of that.
Yeah.
On BT 5.5 billion, carrying debt at 6.9% was costing them roughly BT 379 million a year in interest.
Right.
Cutting that rate basically in half by 3.4 percentage points, that immediately frees up hundreds of millions in cash flow year after year. That's money that can now go to profit and ultimately to you as a unit holder.
That really quantifies the strategic win there. But it wasn't entirely painless, was it? We should remember back in Q1, they had to pay those short-term fees to get this deal done. Wasn't it like BT 163 million to BBL for early repayment and another BT 38 million or so to SMBC upfront?
Yes, that's right. Good memory.
So was that short, sharp pain taking that hit in Q1 worth it?
Oh, absolutely. No question.
Yeah.
They absorbed, over BT 200 million in those one-time fees in Q1. And yes, it's suppressed that quarter's core profit figure.
It made Q1 look worse than it was operationally.
Exactly. But the trade-off was locking in these massive recurring savings starting immediately in Q2. It's a very clear strategic decision. Prioritize long-term financial stability over, smoothing out one quarter's earnings. And structurally, the fund's net asset value, the NAV, it remains solid. It was BT 8.5676 per unit as of June 30th, 2025.
Okay, that makes sense. Let's pivot a bit then. Before we get too carried away by the financing improvements, let's just ground ourselves in the underlying business. What exactly does 3BBI own, and how does that revenue model actually work?
Sure. So the fund basically owns the essential plumbing for modern internet. It's 1,680,500 core kilometers of fiber optic cable.
That sounds like a lot.
It is. To try and put that technical number in perspective,
Yeah.
it's enough high-capacity fiber to stretch around the Earth's equator dozens of times.
Yeah.
It's a really core piece of Thailand's national digital infrastructure.
Okay, a huge network. And the revenue model, I understand it relies very heavily on one major tenant, which sounds like it could introduce some risk.
Yes, that's correct. The business model definitely rests on a primary lessee, which is TTTBB or Triple T Broadband. They lease about 80% of the fund's total fiber assets.
80%.
80%. And TTTBB is also appointed to handle the day-to-day management and maintenance of the network infrastructure. So yes, this concentration is typically the kind of counterparty risk you'd flag immediately in any analysis.
Yeah, that's my skepticism kicking in right there. If 80% of your income comes from just one customer, what happens if TTTBB runs into financial trouble or tries to renegotiate terms down the line? How does the fund protect itself against that single lessee risk?
Well, the main mitigation is really baked into the structure of the contracts themselves. The revenue is designed to be stable because it's based on these very robust, very long-term lease agreements.
How long-term are we talking?
These agreements provide incredible revenue visibility. They extend all the way out to the year 2038.
Wow, okay, 2038.
Yeah. So while the customer concentration is high, that stability is contractually locked in for, nearly another decade and a half. It provides a very strong defensive moat against short-term operational hiccups or market fluctuations.
That long-term visibility really is key, isn't it? Okay, now let's try and connect this back to the bigger macro picture. We've established the fund did a great job lowering its specific cost of debt, getting that rate down from 6.9% to 3.5%. But why are analysts now saying that large infrastructure funds, sort of generally, are suddenly considered high safety assets right now? What's changed?
Right, so this is the macro tailwind starting to blow in their favor. Analysts and firms like LH Securities have pointed this out. They highlight that in an environment where policy interest rates are potentially in a downtrend, or at least expected to fall, funds with high borrowing profiles, like 3BBIF and also DIF, another big infra fund, they benefit massively. Well, the entire cost of capital environment starts moving in their favor. Lower benchmark interest rates, reduce market anxiety about their future refinancing risks. What happens when current loans mature, and importantly, it boosts their potential yield relative to other income-generating assets like bonds.
Okay, so it's like a perfect alignment then. You've got management proactively securing lower internal financing costs through that SMBC deal.
Check.
And now the global economy is potentially signaling that external financing, market rates, could become even cheaper down the road, which would further reduce the financial burden on the debt they still carry.
Precisely. It's a very favorable convergence of internal actions and external trends for a fund like this.
But there's always a but, isn't there?
Yeah.
What's the counter risk here?
Well, yes. We absolutely have to introduce the main counter risk,
right.
Rising government bond yields.
Okay.
Infrastructure funds like 3BBIF are fundamentally yield plays for investors. So if government bond yields were to surge unexpectedly,
which can happen,
then the fixed, stable yield offered by 3BBIF, even if its own dividends are increasing thanks to lower costs, might suddenly look comparatively less attractive. Income investors might think, well, I can now get a similar, or maybe even better, return from super safe government bonds.
Right, so it becomes a relative value game.
Exactly. It's this ongoing comparative battle that in the fund's dividend yield versus prevailing bond yields, that relationship is crucial.
Okay, that makes sense. Which brings us neatly to the moment I think many investors have been waiting for, the dividend outlook. You mentioned they use that Q2 profit plus the big non-cash revaluation gain to finally clear out that accumulated deficit. So what did the fund manager actually announce regarding dividends?
Right, the ability to clear that deficit, which, stood at about BT 1,610 million after Q1. That was the final hurdle they needed to cross.
And they cleared it.
They cleared it. So the fund manager, Bo Duong, who is a very highly respected asset manager in Thailand, they confirmed the immediate return to paying recurring dividends. They announced dividend payment number 35, specifically for the Q2 2025 performance.
Okay, fantastic news for unit holders. And the actual dividend amount per unit?
It's set at BT 0.15455 per unit.
0.15455.
Correct. And the important dates for you if you're an investor. The XD date, that's the date you need to own the unit by to qualify for this dividend, is August 18th, 2025. And the actual payment date is scheduled for September 3rd, 2025.
Got it. XD, August 18th, payment September 3rd.
And this is significant because it officially replaces those less desirable capital reduction payments they were making previously with true regular dividends paid out of profits.
That really is a massive confirmation of the whole financial cleanup story, but I think there's a crucial detail we need to mention regarding the net income an investor actually receives now. Something about a recent tax change.
Yes, this is a really material change, especially for individual unit holders in Thailand. See, since the fund was first established, investors had benefited from a 10-year tax exemption on the dividends they received.
A tax holiday.
Pretty much. But that 10-year period expired at the end of the 2024 calendar year.
Okay. Meaning what for these new dividends?
Meaning that starting from the beginning of 2025, any dividend received by individual unit holders from 3BBIF will now be subject to a 10% withholding tax.
Ouch. Okay, 10% off the top.
Exactly. So while the gross dividend payment, that BT 0.15455, looks good, the final net yield that actually lands in your brokerage account is now lower than it would have been in previous years for the same gross amount. It's a really vital factor to remember when you're calculating your expected investment return going forward.
That definitely shifts the calculation for income investors. Okay, let's look at what the analysts are saying now that the financial picture seems clearer, the dividend is back, but this tax reality has settled in. What are the price targets looking like?
Well, the IAA consensus, which aggregates views from 4 leading brokers covering the stock, they currently have a consensus recommendation of hold.
Hold, not buy.
Hold. It breaks down as 3 hold ratings and 1 buy. The average target price across those 4 analysts sits at around BT 6.60 per unit.
Okay.
And the range is fairly wide, actually, from a low target of BT 5.80 up to a high of BT 7.80.
So that suggests that while everyone agrees the financial health has improved, the stock price might already reflect a good chunk of that recovery, perhaps.
That seems to be the consensus view, yes, that much of the immediate good news from the cleanup is priced in around current levels.
Interesting. Who's driving that higher end of the range then, the BT 7.80 Jurgit, and what's their specific rationale for being more optimistic?
That higher target, the BT 7.80, comes from Krungsri Securities, or KSS. They're the ones with the explicit buy recommendation.
And their reasoning?
Their confidence seems rooted specifically in 2 main things we've discussed. First, that stable, highly visible long-term cash flow profile guaranteed by the leases running until 2038. They really emphasize that long-term security.
Okay.
And second, the significantly improved financial flexibility the fund now has, thanks largely to that lower interest rate environment, both the rate they secured and the potential for market rates to fall further.
So visibility and flexibility.
Exactly. KSS, and I think the broader analyst community now, they're expecting strong, consistent dividend payments going forward, replacing that financial ambiguity and the capital reductions we saw in the past few quarters with predictable income.
Okay, so if we try and step back and synthesize all this for a final takeaway, it seems like you, the listener, should focus on 2 major shifts that just occurred in the fundamental nature of 3BBIF. First, there's the technical financial cleanup.
Right.
That aggressive, maybe even painful debt reduction combined with the, let's call it, timely balance sheet boost from the asset revaluation. That cleared the deficit, stabilized the cost base, that part's done. And second, there's that powerful macro alignment happening. This highly leveraged infrastructure fund, which is now carrying a chunk of its debt at 3.5% instead of nearly 7%, well, it looks perfectly positioned to benefit if there's a global trend towards lower policy interest rates. That further validates its business model and that long-term operational stability through 2038.
So the ultimate metric for you, the income investor, has really changed now, hasn't it? The immediate focus shifts entirely to monitoring that new recurring dividend yield.
The net yield especially.
Exactly, the net yield after that 10% tax. And critically, comparing how competitive that net yield remains when you look at it directly against those changing government bond market rates, particularly in the region. That seems like the true measure of its ongoing success now.
I think that's perfectly put. The transformation, the cleanup, that seems complete. The game now is all about yield comparison and sustainability.
Well, that wraps up our deep dive on 3BBIF. If you have any other stocks or specific topics you'd like us to cover and really dive into the sources on, please do let us know in the comments. Yeah, we'd love to hear your suggestions.
And please don't forget to like, share, and subscribe. It really helps support our team and ensures you get these deep dives right when they drop. Thank you so much for joining us today.